Bonds are breaking rules. Stocks are soaring despite war. Gold dances with Bitcoin. And central banks, once the high priests of predictability, now speak in riddles. This isn't just a market phase. It's a reset. A revaluation of reality. Welcome to FluxFolio Finance. We're entering a new era, not of volatility, but of structural change. Old signals no longer signal. Safe havens wobble. And models built on 30 years of calm are now whispering something new. The rules have changed. Let's start where most analysts stop, with the feeling. Yes, the feeling. Markets, like people, have mood swings. And the mood right now? Disoriented. Like waking up in a house where every room has shifted position. Equities are at all-time highs. So are debt levels. So is geopolitical tension. And somehow, so is investor optimism. How? Because we're not in a bubble. We're in a repricing. A forced recalibration of every asset class, currency, and policy assumption. The culprit? Not one thing, but everything. Interest rates, inflation, AI, war, demographics, debt, climate. Each one a weight. Together? A seismic shift. Let's unpack it. For a decade, the world lived in the zero-rate zone. Post-2008, central banks became guardians of growth. Whenever risk rose, they stepped in, lowering rates, printing liquidity, backstopping panic. And investors learned to trust the playbook. Don't fight the Fed. Buy the dip. Duration over fear. Then came 2020. Pandemic, panic, policy bazookas. $12 trillion injected into the global economy in less than 2 years. It worked, until it didn't. Inflation, once extinct, returned like a ghost of the 1970s. First it was transitory, then it wasn't. Then it embedded, quietly, systemically, into rent, food, energy, and wages. To fight it, central banks flipped. From doves to hawks. From accommodative to aggressive. The U.S. Fed took rates from 0.25% to over 5% in record time. Europe followed. So did emerging markets. But the damage was already done. The cost of capital changed. And with it, everything else. Now here's the twist. Even with higher rates, markets didn't crash. Equities rose. Bitcoin rallied. Gold touched record highs. Private equity stayed buoyant. Even junk bonds found buyers. This isn't irrational exuberance. It's rational adaptation. Investors aren't ignoring risk. They're repricing it. Why? Because cash is no longer trash, but it's also no longer neutral. Because every sovereign is spending. Because AI is promising exponential margins. Because bonds are no longer risk-free, they're volatility machines. And because global capital has no home. Just a hunger. That hunger is rewriting portfolio theory. 60/40ths? Broken. Diversification? Blurred. Everything is correlated. War raises oil. Oil raises inflation. Inflation spooks bonds. Bonds wobble equities. Equities pivot to tech. Tech drives ETFs. ETFs fuel passive flows. It's all connected. And the connections are unstable. That's why volatility isn't spikes, it's undercurrents. Calm on the surface, chaos in the math. And the institutions? They're behind. Pension funds still chase 7% returns in a 3% growth world. Insurance models still assume climate isn't systemic. Central banks still act like tools are enough. But this is not a normal cycle. This is a transition. Demographics are aging. Debt is unsustainable. AI is reshaping productivity without reshaping employment. And now, geopolitics is forcing capital to choose sides. East versus West, dollar versus yuan, democracy versus control. This is not just a market reset. It's a civilizational repricing. The question is no longer, will it revert? It's, what is the new baseline? Because if bonds yield 5%, do equities still deserve a P/E of 25? If war is semi-permanent, how do we model long-term risk? If climate shocks cost 2% of GDP annually, what's growth, really? Nothing is cheap or expensive anymore. Only redefined. And in that redefinition, new power emerges. Let's think about a world without anchors. Who wins? The answer lies in movement. In flexibility. In recognizing the old rules are gone, and embracing the game as it is. Because while the foundations of finance shake, new structures are rising. Let's start with equities. Not all stocks are equal. We are witnessing the bifurcation of the market, a splitting of reality. On one side, AI, megacap tech, semiconductors, cloud infrastructure. Valuations stretched? Yes. But margins? Historic. Capital intensity? Low. Resilience to rate hikes? Surprisingly strong. On the other side, cyclicals, small caps, real estate, regional banks. These are victims of old economics. High debt, low pricing power, rising costs, no story. The result? A market where the indexes rise, but 70% of stocks are treading water. That's not a bubble. It's a rotation of belief. Investors are betting not on themes, but on survivors. And then there's gold. Gold is no longer a barbarous relic. It's a digital anchor. A geopolitical hedge. A bet not against inflation, but against instability. Central banks are buying gold at the fastest pace since 1967. Why? Because gold is outside the system. No counterparty, no sanction, no algorithm. Just wait. And weight matters when the world feels weightless. Crypto, too, is repricing. No longer a rebel, now a reluctant insider. Bitcoin has become the new alt gold. Volatile, yes, but now included in portfolios once reserved for treasuries and commodities. Ethereum? The new fintech infrastructure. Stablecoins? The dollar's digital emissaries. DeFi? Still chaotic, but no longer ignorable. Crypto didn't die, it matured. And in a system starved for uncorrelated assets, maturity is currency. Meanwhile, sovereign debt, the backbone of global finance, is cracking. U.S. Treasuries now yield 4 to 5%, but with risk. Risk of default? Not likely. Risk of devaluation? Absolutely. Because what is a safe asset worth if inflation eats half the coupon? Investors are learning that safe isn't about yield. It's about trust. And trust, like credit, is a slow build, fast collapse dynamic. So what does smart money do in a repricing? It diversifies not just across asset classes, but across assumptions. It doesn't ask, what did well last decade? It asks, what survives the next? Because this isn't about growth. It's about resilience. Infrastructure. Food supply chains. Defense stocks. Energy pipelines. Water access. Battery metals. Digital sovereignty. This is the portfolio of the new age, hard assets. Essential flows. Narratives that don't need quarterly earnings calls to justify their place. The retail investor? No longer in the dark. Social finance, real-time macro Twitter, generative AI tools, and commission-free trading have democratized insight. But democratization comes with noise. And in that noise, those who can synthesize win. That's why education is alpha. That's why perspective matters more than prediction. Because in a great repricing, there are no safe havens, only smart positions. This isn't 2008. This isn't 1973. This is 2025. A hybrid economy. A multipolar world. A digital financial frontier colliding with energy and climate limits. Everything is being repriced. Not just assets, but assumptions, expectations, ideologies. Welcome to the new normal. No mean reversion. No, back to baseline. Only forward, to whatever comes next. Thank you for watching FluxFolio Finance. If this helped sharpen your view of today's wild markets, show it some love with a like. Subscribe if you want to keep seeing through the noise. And drop your thoughts below. Where do you think capital will go when the old maps no longer apply? Until next time, stay sovereign, stay skeptical, and stay ahead of the curve.